Today's Exchange Traded Fridays is sponsored by the U.S. Benchmark Series. The U.S. Benchmark Series makes it easy to invest in the U.S. Treasury market through a series of single Treasury ETFs. With 10 single bond ETFs in the series, investors of all types can invest in specific points along the yield curve, each with the most current on-the-run U.S. Treasury security. For more information on today's sponsor, visit USTreasuryETF.com. That's USTreasuryETF.com.
Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, I'm talking with Jim Lydotes, Portfolio Manager of the BNY Mellon Global Infrastructure Income ETF, ticker symbol BKGI. Jim, welcome to the show.
Oh, thank you. Thank you very much for having me.
Jim, infrastructure has been this rallying cry in Washington for a long time. A lot of people agree with this idea that the U.S. should spend money to repair and upgrade its infrastructure, whether it be fixing broken bridges and highways or by encouraging the clean energy transition. In recent years, we've seen bills like the Infrastructure Investment and Jobs Act, as well as the Inflation Reduction Act signed into law. And these are supposed to help fulfill that desire to fix and improve the infrastructure of the U.S. So with that context, I want to ask you, what is the state of infrastructure in the U.S. today? And are we seeing increased spending on infrastructure following the passage of those laws I just mentioned?
Well, maybe to answer that first question, the state of infrastructure in the U.S. today is catastrophically bad. It is really, really bad. And I'd say, there's pretty general agreement on the condition of infrastructure in the States. There's really nobody taking the other side of that debate. When you ask the question, are we starting to see the spending on infrastructure as a result of those laws being passed? I'd say this isn't something we're going to measure in months or years. This is a generational spend. I'd say a lot of the easy stuff, so things like repairing roads, this can happen pretty quickly, and it has already started to happen. That money is starting to move down to the states and get deployed. If you think about when the infrastructure bill was passed, we're almost at the 2-year point. So it was passed about 2 years ago. The bigger things, those things taking permitting, those can take a very long time. Those take planning. They take staffing up labor. It's not easy to do that right now, as you can imagine. Labor, is as tight as it's been in decades right now. So it's pretty tough to get labor. But also in the U.S., it's really, really tough to get permitting done. So permitting really comes down to the very micro regional level. And so those things take a lot of time. So, a lot of this spending was never going to happen overnight, which is okay. But it is coming. And one of the other things that I'd say is causing maybe a bit of a delay is that a lot of the infrastructure spending, it's really competing with resources that are being pulled for the entire reshoring effort. So certainly all the geopolitical tensions that we're seeing over the last 2 to 3 years is really heating up the efforts to try to reshore manufacturing into the States. And that's competing for a lot of the same resources, whether that's labor or materials, that the infrastructure spending is going to compete for. So again, I think it's just it's a when, not if. Very long way of saying these things take time, but the groundwork is being laid. One of the things that we've been talking to a lot of the aggregates manufacturers in the U.S. over the last couple of weeks about is, why have we not seen those ground breakings take place yet? And pretty much universally across the board, there is this belief that 2024 is going to be the year where you really start to see more of these groundbreakings taking place. So again, we're starting to see the infrastructure spending. Much more is going to come. If you look at all of the spending being announced, about $300 billion of the spending that's been announced is already heading down to the states. But even that money hasn't really kind of made its way into the ground. So again, it will. The absolute best part of this bill, and what's been the case is as far back as even before the 2020 elections, even the 2016 elections, is that this bill is massively bipartisan. In a world where almost nothing is bipartisan, there's no politician in the U.S. who's on the other side of this debate. So everyone's for infrastructure spending. Everybody understands it needs to happen. And so again, there's a lot of things you have to worry about when you head into midterm elections or presidential elections. But infrastructure is one thing that you can sleep pretty well at night because there's not much political debate.
That makes a lot of sense. So, Jim, I'm curious, where is the infrastructure spending being focused? I've heard there being subsidies for solar panels, EV charging stations, and things like that. Is most of the money heading into these new green projects, or is it broader than that?
There certainly is some money being headed into the green, into the more green projects, but it is quite broad. We've gotten a lot of money that's been funneled into investment tax credits to incentivize the building of more renewable electricity. So for sure, that is already starting to happen, and that's going to continue to happen. But there's also a lot of funding that was headed into bridging the technological divide. I think COVID laid bare even more bare than it had before. This economic divide and the inequalities that we see in the country, one of the things that can help bridge that is bringing better broadband service to rural parts of the United States. 10% of the population live in areas that don't have great internet access. So that's one of the big things that are being addressed in the plan as well. If you look at, the water infrastructure that we have in this country, I always say this is a first world country with third world water infrastructure, but 500,000 kids in the country today are in schools or daycare centers that don't have safe drinking water, which is crazy when you think about it. It's 2023. This is the USA. It's wild to think about that. So that's something that's absolutely being addressed right now as well. 1 in 5 miles in the U.S. are in poor condition. The road work needs to be fixed. About 50,000 bridges are in poor condition. It's a lot of bridges, right? It's a lot of roads. There's over $100 billion that's meant to fix the inadequacies of bridges and roads. So, to kind of get at your question, it's pretty broad, and it's hitting, whether it's the technology spend, whether it's road spending, whether it's renewable energy, whether it's water. There are a lot of categories to spend that this bill is targeting.
So, Jim, you, of course, manage the BNY Mellon Global Infrastructure Income ETF, ticker symbol BKGI. You've already kind of made the case for why people should consider investing in infrastructure, but I'm curious, if I directly ask you, why should people consider investing in this ETF, what would you say?
Yeah, I'd say there's really four things that come to mind on that. So maybe the first point is a lot of what we just talked about. Right now, we're standing in front of probably the greatest period of infrastructure spending that we've seen in about 80 years in the U.S. And it's all signed into law. So again, you don't have to worry about that getting pulled back at all because it's already been signed into law. And again, it was first announced 2 years ago. And when it was announced, an interesting thing started happening. It started siphoning capital out of Europe to the U.S. So a lot of European infrastructure companies saw the programs that were in place in the U.S. and they thought it made a lot more sense for them to bring that capital over to the U.S. Europe responded and said, gosh, we can't let all this capital leave Europe. So Europe has responded with a lot of very large scale infrastructure projects of their own. So right now it's almost an arms race of regulation that's competing for investor capital, which as an infrastructure investor, that's a fantastic backdrop. So, whether it's the U.S. infrastructure programs or the programs we're seeing out of Europe, a lot of regulations are targeting infrastructure spend, which creates a really, really good backdrop. So that's the first point. The point number two, I'd say, is inflation. Higher borrowing costs, higher labor costs, higher input costs. The world is grappling with inflation that most of us in our investing lifetime have not ever had to experience. Last year, almost every business, whether it was Coke or Pepsi or Kraft Heinz, almost every business was able to take pricing higher. This year, we're starting to see some of that unwind. So people are starting to worry about a lot of that pricing that came through with inflation last year might have to turn around, which is not good for equity holders. With infrastructure businesses, you literally never have to worry about that because all of these businesses, they operate with very long-term contracts and they have inflation pass-through mechanisms built automatically into them. So you never have to worry about those inflationary pressures going away, which is a really good thing for these businesses. The third point I'd say is you're getting a real 6% dividend yield. And I think that one word, real, is probably the most important word there. People could look at a bond yield or bond yields as high as they are today, whether it's the 2-year treasury at over 5%. Just before I jumped on this call, I was looking at the 10 years is almost at 5%. So these are pretty high rates. And that can feel pretty good, right? Those are very high nominal yields. But if you put your money into a 10-year treasury today for that 5% yield, that 5% nominal yield is all you're going to see, but that's going to get eroded with inflation. And when you get your money back in 10 years, that capital that you put in on day one is going to be massively eroded by inflation. You're not going to have that with equities, with infrastructure equities. These equities, they pay dividends that are going to grow at least as fast with inflation. But also the capital that you're putting in today, that should also appreciate in an inflationary backdrop. So all of it, the yield and the capital, all of that is much more protected in an inflationary environment. You get none of that protection with bonds. So even though the headline yields you find in bonds are higher than they've been certainly in years, you're getting no inflation protection. And I do believe we're in an inflationary environment. And then maybe the final point on this, none of these are discretionary businesses. So you don't have to, with infrastructure, you don't have to bet on the recovery and the spending of the Chinese consumer. You don't have to worry about trade wars. Infrastructure businesses are largely domestic focused, whether they're US businesses or Spanish businesses, French businesses. They're largely focused on their own economy, and they have very little economic sensitivity. So think about, a water utility or an electric utility or an energy pipeline, very little economic sensitivity. So, really all you have to worry about is collecting that dividend yield, and that dividend yield is going to be protected in an inflationary environment. So if you're worried about economic, instability out there in the market, you don't have to worry about that with an infrastructure fund.
That's some great color. And what is the yield on the ETF right now?
Yeah, so the way I like to look at this is on the yield on a go-forward basis, meaning if you put $100 into the fund today, what's the income that you would expect to receive over the next 12 months? And so the forward 12-month dividend yield is about 6.3% right now. We've been managing this infrastructure ETF. It'll be a year in November, so we're about 2.5 weeks away from 1 year. But I've been managing the same strategy for other institutional clients before we launched the ETF for over 12 years, and that commitment to that 6% dividend yield has been something that we've held for the entirety of the strategy since we launched it in the summer of 2011. So the yield right now, again, sits at about 6.3%, but that has been a level at or above 6% that we've been able to maintain for over 12 years now.
Yeah, 6%, that certainly is attractive. And I was going to ask you how, that compares to the 10-year treasury yield, which is now 5%, but you kind of answered saying that, that 5% treasury yield is going to be eroded by inflation, and you're not going to see a growth in that yield like you would with the dividends that you get in BKGI. But, exactly. I've been looking at, some of those dividend stocks, things like utilities, and they've been hit pretty hard in the recent market environment. Does that mean it's an opportunity right now because these stocks have sold off on the back of those higher interest rates?
Yeah, that's a great question. So one of the way that we had been positioned when we launched the strategy a year ago, we were really, really underweight US utilities and fairly overweight European utilities. European utilities have historically been a lot less sensitive to moves in interest rates than US utilities have. And you've seen over the last 12 months a tremendous amount of outperformance of the Europeans relative to the US. But exactly to that point, we are now starting to see, especially with what you saw the last couple of weeks in September, that 50 basis point move up in bond yields, the U.S. utilities got hit pretty hard. We're seeing a ton of opportunity right now in that space to start to close that underweight and shift some of that weight from Europe into the U.S. In fact, we're working on a paper right now. We're calling it Coming to America. And it's really all about that, just shifting a lot of that European weight back to the U.S. based on the opportunities that we're seeing that have arisen in the last couple of months with all that volatility.
Super interesting. And can you tell us a little bit more about the holdings in the ETF? If I'm not mistaken, there's currently 31 holdings. What are
Yeah.
the, top sectors and top
Yeah.
stocks and things like that?
Yeah. So one of the things that we've always done, and kind of one of the, I'd say, most differentiated parts of our infrastructure strategy is we do look at an expanded opportunity set. So most of the players in the listed infrastructure space will invest in utilities, they'll invest in pipelines, and they'll invest in transportation infrastructure. So think toll roads or airports. We've always thought that the opportunity set is broader than those three areas. So while we do own utilities, we do own transports, and we do own energy pipelines, we'll also own some very idiosyncratic areas of infrastructure. So one place that we're finding a lot of opportunity right now is European telecom. The largest weight in the fund today, sitting here on October 19th, is Orange. And so Orange is the former France Telecom. So think of, essentially the AT&T of France. They have a big business in Spain as well. Telecom businesses kind of get a bad rap because they don't grow really well and they're super capital intensive. So some of these businesses spend about 20% of every dollar they bring in revenue into CapEx and trying to get you onto that next generation of internet service. So super capital intensive. They don't grow really well. So investors have largely disregarded this entire sector for probably the last 15 years when I think of European telcos. So some of these equities are some of the cheapest defensive equities you'll find anywhere in the market. 5-6 times EBITDA. You can sometimes get them under 5 times EBITDA. So really, really cheap businesses. A company like Orange, what they're doing is they've recognized that their growth has peaked. And so they're saying, all right, well, let's change the profile of our business. Let's take more of that capital that we were putting into the ground and not getting a return on, and let's redistribute that back to shareholders in the form of dividends. So dividends are growing from an already really high level. They're paying down debt, deleveraging the balance sheet, just really changing the profile of the business. They have a new management team in place. We think she's fantastic, CEO. And so a business like that, you're still, it's done really well for us this year, but it's still generating about a 6.5% dividend yield. Cash flow return to shareholders is improving. And it's, again, I think it's going to take a while to change investor sentiment around that group. So while that happens, we think there's a ton of opportunity to get a lot of yield, a lot of value, and then get the re-rating. So that's one area where we're finding value. And then maybe, the other, I'd say, probably non-traditional space where we're finding value is in the healthcare REIT segment of the market. It sounds like a pretty niche-y place, and it can be, but there's one name that we own today in the fund. It's called Omega Healthcare Investors. They are the largest owner of aged care facilities in the United States, and so it's a healthcare REIT, so it's technically a REIT. But if you think of the different types of infrastructure, this is I call it social infrastructure. So over 80% of the states in the U.S. today have restrictions on supply coming into nursing homes. So you and I couldn't just pool our capital and build a nursing home in most places because there's limits on how much supply can come into the market. So as a result, if you have a supply constrained market, as demand continues to grow with the aging population of the aging demographic of the baby boomers, then you have this really nice supply demand dynamic in this space. And this is a space that was hit pretty hard on the back of COVID, as you can imagine. Utilization rates came down, and people, for about 12 to 18 months, people really weren't moving into these facilities. So utilization was coming down. It was a pretty challenging spot, but they've gotten through it. And so now utilization rates, every time they report, they keep ticking higher. And again, supply is constrained, demand continues to grow. But, because of what happened in COVID, these businesses are still offering quite a bit of value. And again, it's an area you're not going to normally find in a traditional infrastructure manager's portfolio, but it's I'd say representative of that broader view of infrastructure that we've always taken.
Certainly sounds like there's an eclectic mix of stocks in your ETF, Jim. And
Absolutely.
I should note the fund is actually flat this year, and that's much better than the S&P utility sector, which is down 14%. So quite a bit of
Yeah,
outperformance.
that's right.
So Jim, I wanted to ask you, how does this ETF BKGI fit inside of a broader portfolio? Who is it for?
So I think a fund like this fits perfectly for someone who wants a defensive fund that generates a lot of inflation protected yield, but also that will benefit from this really, really big theme of U.S. infrastructure growth, and growth that's coming through in Europe and Asia as well. So I think that the global nature of this is important because as an actively managed global fund, I mentioned earlier how we were pretty overweight Europe about a year ago when we launched the strategy. We've been pulling that down, and now we see opportunity to reallocate some of that weight to the U.S. with some of that volatility. I do think you want a manager who has truly a global opportunity set, who can move weight where they can find opportunities within that broader set. So if you're looking for an actively managed fund that can arbitrage those opportunities, but you want a defensive, all the defensive characteristics that you'd expect with an infrastructure fund and generate a lot of inflation protected yield. Again, I think that is who this fund is for. Someone who's looking for a defensive, inflation protected, higher yield portfolio with the ability to arbitrage value across the globe.
Well, fantastic. Jim, we're going to have to leave it there. You gave us a ton of great insights. Thanks so much for your time.
No, thank you very much. I appreciate it.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.